Most people spend 40 hours every single week working tirelessly to earn money. Another 20 hours frantically spending it. But less than one single hour truly understanding where that money goes once it leaves their hands. Think about that. We trade our precious time, our energy, and our mental health for a paycheck, only to hand it right back to businesses whose inner engines we don't even care to understand. What if the difference between financial stress and permanent wealth isn't how hard you work, but how clearly you see the hidden machinery running behind the products you buy every day? There is a master key to this game, a framework so simple, yet so deeply profound, that it reshaped how the world's greatest investors look at every store, every brand, and every stock on Earth. Peter Lynch didn't just look for good companies. He classified every business on the planet into 6 distinct categories. 6 financial identities that dictate whether a stock will multiply your life savings tenfold or quietly destroy your entire future. And yet, thousands of retail investors lose millions of dollars every single year, simply because they mistake one category for another. If you don't know which category a stock belongs to before you invest a single dollar, you aren't actually investing. You are playing a high-stakes game of financial roulette with your eyes completely blindfolded. So, which of these 6 categories holds the secret to life-changing returns? And which one is an invisible trap waiting to wipe out your portfolio? To answer that, we have to step inside the mind of an investor who proved that mainstream financial analysts are often looking in the absolute wrong direction. Imagine stepping into the first category, the slow growers. These are the aging giants of the corporate world. Massive, mature companies that once dominated their markets, but have now run out of room to expand. They are like giant ocean liners, stable, reliable, moving smoothly through calm waters, but moving at an absolute crawl. They don't reinvest their profits into explosive new growth, because there are simply no new oceans left for them to conquer. Instead, they pay out steady, predictable dividends, month after month, year after year, for an investor looking for safety, peace of mind, and modest passive income. A slow grower feels like a comfortable blanket, but here is where the devastating trap lies. If you buy a slow grower expecting it to double or triple your wealth, you are chasing an illusion. You are expecting an elephant to run at the speed of a cheetah. Yet, millions of beginner investors fall into this exact trap every day, buying old, famous household names, wondering why their money sits completely frozen for an entire decade, while those slow giants quietly drift along. An entirely different category of stocks is hiding right beside them, quietly generating massive, steady wealth without drawing any attention from the news. Welcome to the stalwarts. These are the corporate heavyweights, multi-billion-dollar titans that grow at a reliable, steady pace, year in and year out. Think of the products you reach for every morning. The toothpaste in your bathroom, the soap by your sink, the beverage in your fridge. No matter what happens to the global economy, whether inflation surges or interest rates spike, people keep buying them when a severe recession hits and the broader market panics. Stalwarts don't collapse. They hold the line, standing like immovable fortresses amidst the financial storm. Lynch loved keeping stalwarts in his portfolio, not because they made him rich overnight, but because they provided an unbreakable shield against economic disaster. If the market dropped 30%, a portfolio backed by stalwarts offered absolute peace of mind, protecting hard-earned capital while others surrendered to fear. But if stalwarts offer safety, and slow growers offer dividends, where are the legendary multi-baggers actually born? Where are the investments that can transform a modest $1,000 investment into a fortune that changes a family's trajectory forever? That brings us to the third category, the undisputed holy grail of financial storytelling, the fast growers. These are small, aggressive, rapidly expanding businesses, compounding their earnings at 20, 25, or even 30% year after year. They are not huge, famous national icons. Not yet. They are hungry, agile, and expanding like wildfire across local towns and new markets. Imagine a small, regional restaurant chain with a line of eager customers stretching around the block. Every new location they open pays for itself in less than a year. The business generates mountains of cash, and management uses that cash to open 5 more locations nearby, then 20, then 200. This is the mathematical engine of explosive growth. The pure, unfiltered power of compounding in real time. When you catch a fast grower early in its life cycle, while Wall Street analysts are still ignoring it because it's too small for their institutional mandates, you hold the key to an asymmetric financial win. This is where legendary 10-baggers are forged, stocks that multiply your initial investment 10 times over, turning quiet observations into life-changing reality. But here is the dark, uncomfortable truth that nobody on financial news wants to tell you. Fast growers are breathtakingly dangerous. When a fast-growing company runs out of room to expand, or when its balance sheet gets choked with debt, the collapse is swift, brutal, and unforgiving. A single bad quarterly earnings report can send the stock tumbling 50% in a single trading session, crushing every investor who blindly chased momentum without analyzing the underlying balance sheet. Which leads us to a critical, terrifying question. How do you know when a fast-growing company is about to run out of runway? Before the stock price collapses off a cliff, the answer lies in watching the cash flow, not the hype. If a company is expanding using its own internal cash, it builds a strong, durable foundation. But if it is expanding by taking on massive bank loans or constantly diluting its stock, it is a fragile house of cards waiting for the slightest economic breeze to knock it down. And just as investors are seduced by the high-octane thrills of fast growers, they often wander straight into the most treacherous, misunderstood category in the entire stock market: the cyclicals. These are companies whose profits are tied directly to the unpredictable ups and downs of the broader economic cycle. Auto manufacturers, steel producers, chemical suppliers, airlines, and luxury builders. When the economy is booming, cyclicals look absolutely unstoppable. Their profits skyrocket, their store counters are packed, and their stock prices surge to breathtaking highs. Financial news outlets run flattering headlines, calling management visionary, and retail investors rush in, buying at the absolute peak of the cycle. Then, the shift happens, quietly. Suddenly, the economy cools off, demand dries up, massive warehouses sit full of unsold inventory, and fixed operating costs begin eating the company alive from the inside out. Within months, profits vanish into thin air, and the stock price plummets into a terrifying tailspin. Buying a cyclical stock at the wrong time is one of the fastest ways to destroy a lifetime of hard-earned savings. Because unlike a great fast grower that eventually recovers and climbs to new highs, a cyclical company can take years, or even decades, just to get back to where it started. Yet, for an investor who truly understands economic timing, cyclicals present some of the most lucrative, asymmetric opportunities in market history. If you buy a cyclical when the industry looks completely dead, when headlines are screaming panic and competitors are filing for bankruptcy, you are buying dollars for pennies. When the economic clock turns and recovery inevitably arrives, those exact same stocks can soar 500% in a matter of months. It is a game of extreme patience, strict discipline, and deep emotional control. A game where you must willingly walk toward the fire when everyone else is running away in blind panic. That exact same emotional courage is required for the fifth category: the turnarounds. These are broken, beaten-down businesses on the very edge of insolvency. Companies that have suffered terrible management decisions, accounting scandals, or shifting consumer habits. The public hates them. Wall Street has abandoned them, and their stock prices look like a straight line down to zero. To the untrained eye, a turnaround looks like an absolute toxic wasteland, but to a forensic investigator, a turnaround is an incredible mystery waiting to be solved. Lynch realized that if a dying company can take just a few decisive steps, cutting unprofitable divisions, restructuring its debt burdens, or bringing in a brilliant new leadership team, something magical happens. The company doesn't need to become world-class to make investors rich. It simply needs to survive. When a stock priced for bankruptcy manages to avoid liquidation and returns to basic profitability, the re-rating by the market is explosive. It is the financial equivalent of a phoenix rising from the ashes, offering returns that rival even the fastest-growing technology stocks. Yet, the graveyard of finance is filled with investors who bought into failing companies hoping for a turnaround, only to watch them go completely bankrupt. How do you tell the difference between a real turnaround and a business heading straight into permanent zero? You look at the balance sheet. Specifically, net cash. If a troubled business has enough cash on hand to pay off its short-term obligations and survive 2 years without making a profit, it buys itself precious time to fix its operations. Time is the ultimate friend of a business making a comeback, but it is the ruthless enemy of a business choking on debt. Finally, hidden away in the quietest corners of the market, sits the sixth and most elusive category of all, the asset plays. These are companies sitting on incredible hidden value that the market has completely failed to realize. It could be a forgotten real estate portfolio purchased decades ago, a collection of valuable patents, a hidden subsidiary business, or millions of dollars in net cash sitting quietly on the balance sheet while the entire market cap of the company trades for less than that cash alone. An asset play is like finding an old, dusty trunk in an attic, opening it up, and realizing the lock itself is made of solid gold. Wall Street often misses these opportunities because analysts are hyper-focused on quarterly earnings reports, ignoring the massive store of value hiding right underneath their noses. When a private buyer, an activist investor, or a corporate raider finally notices that hidden value, they buy up the stock, unlock the assets, and instantly deliver immense wealth to those who saw it first. 6 distinct categories. 6 completely different sets of rules, risks, and economic realities.